आप लोग चेक करो एक बार. We should be live by now. Live है बाबू. Is it? Is there? Great. Did we start? Great. So, Mr. Good evening, friends. Thank you so much for joining us for this new episode of Conversation. I think we are starting this after a very long period of time, maybe almost two years now. And for this special episode today, we have none other than Mr. Sahil Kapoor. I think Sahil needs no introduction. We have been following Netra, which is published from his desk, I think for almost more than a year now. Sahil is the head of products and market strategies at DSP Mutual Fund. And Sahil has a wide-ranging experience across asset class and businesses. I think he has an experience of more than 18 years now at DSP. He takes care of the products and strategies for them. So today we will try and cover many aspects of market with him. We'll try and understand global micros and macros with him. And since it's a very difficult time for all of us in the market, we will try and understand from Sahil how we can navigate it. There is every day something or other we get to hear in the market. What should we be doing as an investor? What should we be knowing it? So I think there's no better person that I could have found today to answer some of these questions. Sahil, would request you to enlighten us what should we be doing and what should we be knowing and what should we not be knowing in this market. So now I would like to bring you into this conversation and the proceeds are yours, dear. Thank you so much.
Thank you. Thank you, Vikasji, and good evening to all of you. So I will probably be sharing a few thoughts with you very quickly in terms of what's happening with earnings, what's happening with markets, and then probably try and touch upon some of the issues that which are in discussion today. Some of them are very difficult to think about, but we'll try and put some thoughts around them. So I will first, try and give you some thoughts around what will happen to various aspects when we look at them from the prism of data, right? So let me start off by sharing some reflections on corporate earnings and valuations. So first, let's look at what's happening with valuations. I think that is one of the most important aspects in the market is how the market is valued. So Indian stocks, when you look at it from a let's say a broader perspective, they seem to be expensive. And why do I say that? When you look at the data on your screen, it shows you the Nifty price to earnings, where the earnings are the peak earnings. So how does this data work is that you take the highest EPS that has been recorded and then plot the price against that highest EPS. When you look at this data, you will find that currently the earnings trajectory, let's say the earnings growth, which is at 8 to 9%, is against a valuation which is more or less very close to the peak valuations of previous cycles. Prior to COVID, when markets traded at 22 to 25 times, this was usually the peak of the cycle, but this time the markets have traded for an elongated period at this price. And therefore, it seems that market participants have now started to make peace with it, saying that maybe this is the new average. But the fact of the matter is that for all of the history that we have, last 3 to 4 years in terms of valuations is the aberration. So, from a historical standpoint, we stand at about one standard deviation over and above our long-term averages. Whichever way you look at it, when valuations are high, they usually produce subpar returns, right? And that is what data has shown us. So if you look at this slide, there are two lines, orange and black. The orange line is 1 year forward return, and the black line is the 1 year forward price to earnings multiple for Nifty 500. What does it show you? They are more or less, they move in the opposite direction, which means that when valuations are high, forward returns tends to be low. And currently, valuations are quite high compared to their own history. So there seems to be the case that probably future returns could be muted, or markets have to do one of the two things. Either they consolidate for a while, or probably face a correction in terms of valuations where valuations come down. Either of the two outcomes are possible. The third outcome, which is that markets continue to rise, is also possible, right? There is no way to predict whether the markets will not rise or rise, but when you look at history, the weight of the evidence tells you that whatever upside that we'll have will be largely based on luck, not based on how history has moved, right? So we need some new paradigm, and the idea is that finance is set in numbers. If you, let's say, pay up, which means that you buy expensive stocks, eventually your returns will be muted. And that is what history has shown. It might not look like so in the short term. That means even sometimes when you buy expensive stocks in the short term, you might make money, but that is not how your probability will work out. If you buy expensive stocks, the portfolio still gets open to more accidents, more prone to accidents than not, right? Even when you look at, let's say, comparative table globally, India is among the top two most expensive on earnings yield, where also our ROEs, return on equity, is one of the highest in the world, second highest for that matter, just behind United States. One of the reasons why we have done so well, but also our earnings yield is quite low, which means that multiples are being driven by very high quality of earnings in India, right? Now the question is, can this high quality of earnings support our multiple? Partly, yes, it has supported, but if we continue to deliver 20% plus earnings growth, I think the multiple will get supported, right? So maybe the conclusion of the first three slides is that A, markets are expensive. B, they're expensive for the right reason. What is that reason? That India has delivered. India has delivered very high quality of earnings where ROEs are quite high, second highest in the world globally. Plus, it has also delivered very strong earnings growth. I will show you some data as we move ahead. But the question is, can we sustain the earnings growth? And what is the sustainable number we need? When you look at the numbers, I think we need about 20% plus earnings growth for multiples of 25 times or 24 times to sustain. Do we have that number right now? Okay, so then we look at where are we in terms of earnings growth, and then make an assessment how easy or tough it is going to be. Like, so let's look at some data. This is the data which tells you that where margins and sales growth is right now. So when you look at corporate profitability, it is driven by two factors. First factor is, are we selling more of the same thing? So which is sales growth. If a company is able to sell more, it will probably make more profits. The other is, can the company sell it more profitably, which means that at a higher margin. If it can increase its margin, even with a flat sales, it will increase its profitability. Third could be that it is increasing both. It is also selling more and also at a higher profit margin, which is the best era, which is sort of the dream era that most companies will think about. Now look at this chart on your screen. The top line, which is the top panel, is profit margin. It's close to at lifetime high for Indian stocks, give or take. And look at the revenue growth, which is the bottom panel. It has already tumbled down. In fact, when you look at the numbers, revenue growth, which was about 20% plus post-COVID, has now come down to mid-single digits, about 5-6%, and margins continue to be at relatively very high place. How high are the margins? Currently, the corporate margins in India are close to their peak, one of the highest levels that we've seen. When you look at let's say, the headline margins for all sectors put together, they'll be around 16%, which is very, very high on an average. We haven't seen this kind of numbers ever. In fact, other than US technology stocks, there is no other index in the world which has a higher profit margin. What Indian NSE 500 is showing right now. So the probability that margins go up is very low, right? Second thing is, how will profits grow and at what pace? So for profits to grow at 20%, you can have two levers. One, sales growth goes to 20% and margins are constant. So your profits will grow at 20%, or margins expand, right? And maybe sales growth is at the same level. In both these cases, I think you will find that data is not very supportive as of now. As I told you, margins are already at the peak, very little room for them to rise. B, sales growth has already come down to about 5% or so, right? Now, we can make an assessment. Are there any levers in the economic data which tell us that sales growth might go back to 20%, right? We'll have some sense of understanding if we look at some data points, right? So let's look at some data points. Now, the crux of the argument, if you are following my line of thought, is first, I told you that valuations are expensive. How expensive? Between 20 to 24 times. Second, I told you that if valuations are high, there is a likelihood that you will need higher earnings growth, maybe 20% plus, for that earnings, for that valuations to sustain. Now, third, I told you that in order to have 20% plus profit growth, either you need higher sales growth or you need higher margins. In both the cases, it seems difficult. As I told you, higher margins looks very unlikely. Maybe we can get higher sales growth. Okay, so let's look at data which will tell us whether sales growth is at 5%, can it go to 10, 20, 0%? What are the other scenarios which are possible? So let's look at some hard data. When you split India's corporate sector, you will find that there are two type of companies. One, export driven. What are export driven companies? For example, IT companies which are listed, part of auto ancillary companies, you know, pharmaceuticals, textile companies, a few chemical companies. All these companies put together are export driven, right? As you know, our export growth is about 1 to 3%, depending on which sector we are talking about. Our software exports growth, particularly for the listed universe, X of GCCs, because GCCs or global capability centers are not listed, many of them. So software export growth is between 2 to 5%, depending on which companies we are talking about, right? In fact, currently it is about 2.5%. So, and for most other export items, the growth is less than 5%, right? So, which means that export is out of the picture. 5%, let's say, if we assume, and we assume 4% earnings growth, then our sales growth will be somewhere in the vicinity of 8 to 10%. When it comes to domestic economy, let's look at some of the numbers. Look at the nominal GDP growth rate. It's about 9.7. In fact, our nominal GDP growth rate is now slightly lower than what it was 12 months ago. It is lower than the pre-COVID average, and it is much, much lower than the best phase that we had. You can look at any economic data, whether it is credit growth, money supply, GST collections, personal loans, passenger vehicle sales, oil imports, housing loans, corporate wage bill, rural wage growth. All these data points which tell you about consumption are slower than what they were 1 year ago, slower than their pre-COVID average, slower than the India's best period, which was 2003 to 8. And why am I selecting this 2003 to 8 period? Because this is the period in which we saw the biggest bull market. Almost 5 years of equity bull market where market went 6 times. Valuations were lower than what they are today. Lower. Please note that very carefully. Today's valuations are higher than that bull market. And just last month, in terms of time scale, we crossed that threshold that this bull market has now become longer than it was in 2003 to 2008. So the stock markets are behaving as if we are in 2003 to 8 phase, although the data is not. This is the data that you see on your screen. Very different from what the economic data is. The stock market has a very different trajectory. Look at the manufacturing and capex data. Almost all data points you can see, except one or two. Services export is an exception where the growth is slightly stronger. You can see almost all other data points are slower now. And similarly for capex, capex has a qualifier where central government oriented capex is still higher. It is still decently driven, although it is still not in double digits. You can see that, for example, cement volumes are holding up, but still in single digits. And IAP capital goods, of course, is still in single digits. You can see that these numbers were, you could call them crazy in 2003 to 8 number. The CAGR numbers are 40, 50%, which is unbelievably high. We haven't seen that kind of numbers again. And not to expect those numbers also because the base was also much more smaller. But the fact of the matter is that most economic data today is slow. Why am I showing you this data points? Look at the outcome. The outcome is that sales growth has actually slowed down in corporate India. Now, let's make an assessment. If sales growth has slowed down to 5 6%, all economic data that you see is also in mid single digits or low single digits. How do we get to 20% earnings growth? Let's assume that we see a revival based on many factors which have happened. Let's say that RBI rate cuts begin to help us, which of course they will. Um, there is more monetary stimulus. Let's assume that all global tensions also go away. And if we see a recovery, how high will the economic growth number look like? Let's say we go back to 12% nominal GDP growth rate. Question is, can we go back to 20% sales growth? Right? It's going to be a very, very tough task. And if we don't get to a 20% sales growth, can we go back to 20% profit growth? Once again, a tough task. In fact, if you look at data for the last 20, 30 years, the only times India has done 20% plus profit CAGR growth is the 2003 to 8 cycle and the post-COVID cycle. So you can actually earmark about total of 6 financial years where India has shown a 3-year CAGR of 20% plus earnings growth, right? So it's going to be hard. It's not an easy target to be. Now the question is, if it is going to be so hard, what will be the outcome for the market? The outcome for the market could be that you need probably lower valuations to justify lower profit growth, right? Which means that an outcome where valuation slows down, where markets go in a consolidation or in a correction phase. We'll talk about valuations first and then come back to the corporate balance sheets. This is where the valuations are today. Probably for mid and small cap space, the valuations are much higher. You can see the current median multiple for stock number 101 to 500 is about 44 times. This is a median multiple of the universe. If you look at the index, which is the mid and small cap 400, the multiple is around 34, right? Now, you can argue that 34 is much lower than 44, but a 34 multiple with an ROE of about 14, 14 and a half, and earnings growth of about 9% looks slightly out of place, right? So in FY25, X of OMCs and fertilizer companies, mid and small cap universe did a earnings growth of only 9%. And in the first quarter of 2026, mid and small cap earnings growth is about 5%. So this kind of earnings growth at 33 or 44 times, or you can pick any multiple you want. You can do an elimination method. The fact of the matter is that 60% of the companies are trading at a multiple of 40 times or higher. So it will be very hard for you to dissect data and say that we are in some cheap category. So for the valuations to get justified, the only method is stronger earnings growth. And the levers which I showed you do not justify 20% plus earnings growth. They do justify earnings growth of 8 to 9 or 10%, which is also very, very good. But for that growth to get reflected in markets, the valuations have to be lower from where they are right now. Now, also please note that these are all the mathematical calculations or how I think about the market. The market may or may not agree, right? And market has its own way of functioning. It may or may not agree. It can continue to trade at a much higher multiple, continue to rally. The only differentiation is that as an investor, how do you expose your portfolio to markets is very, very important. Do you become more aggressive when there is a huge margin of safety, which is which is when markets are cheap, or you expose your portfolio to markets more when valuations are high, which is, for example, right now. So that distinction you have to make as an investor, because the only way to exercise a good investment policy is to be a conservative investor, which means that be aggressive when valuations are cheap, margin of safety is high, and be very conservative when margin of safety is absent. Today, maybe is that kind of a phase, right? Uh, I'll talk about the large caps, but first look at what is good about this cycle? Where are the green shoots, so to speak? So this is the picture of the corporate balance sheet. You can see that at this point in time, we ended FY25 at the best balance sheets that corporate India has seen for a very long time, maybe forever, right? We have data going back to 20, 30 years. Corporate India hasn't had this kind of strength on the balance sheet for a very long time. And the reason is that cash flows have remained very, very robust. Profitability has been very high, although the growth rate has slowed down. But many companies utilize the breakneck profit growth of the last 2, 3 years to repay debt. They paid off their loans, did not do a lot of capex, and their balance sheets have improved tremendously. So now think about it this way. This has two outcomes. Okay, you can think about it in two manners. One is you could argue that the balance sheet is very strong, which is correct, right? Which is a fact. The other point is that corporate India has not invested enough, right? So, for example, for a company to grow its sales, it will have to reinvest quite a lot, right? Have we done enough reinvestment to get back to 20-25% growth rate? Maybe the answer is no, and that is the reason why the balance sheets are so strong, right? That also means that corporate India can quickly start investing more, right? It can borrow money, it can probably lead to a higher capex and rebound in the economy. It's quite possible because it has the balance sheet. And another conclusion that you can draw is that corporate India will also be very resilient to any kind of shock. Even if the economy slows down or if there are external shocks, corporate India balance sheets can withstand a period of problems, right? And please do not confuse this corporate balance sheet strength with stock price strength. These two are very different things. Stock prices are influenced by the vagaries of our sentiments. Balance sheets are not, right? So balance sheets is possibly one of the most important and positive aspect of corporate India today, and it will give it a lot of resilience, specifically with all the challenges that we face today, right? So this is the crux of the argument where what we are saying. Maybe let me sort of summarize this section by saying that uh, valuations are high. For that valuation to sustain, you need higher earnings growth. Our earning growth for the last 3, 4 years was about 20-25%. It has now slipped down in low single digits, which doesn't justify the valuations we are trading at because our ROEs are just about 15%. We can't trade at 25, 30 times multiple for earnings growth of 5 to 9%. Now, then question came, can earnings growth go back to 20%? Current data shows it looks unlikely, right? We need some more time or some new trigger for earnings to go back to 20% plus. If earnings are not going back to 20%, valuations have to derate. How do valuations derate? Either the stock market goes through a consolidation period where stock prices do nothing over a period of time and earnings catch up, or prices fall, right? Or stock prices fall and valuations become more justified. Out of these two scenarios, which one will happen? We have no idea. It is unwise or almost impossible to say whether case one or two will happen. There is no crystal ball. It is only time will tell, right? Now, what we do is that we look at then what should we do? So, one of the ideas that we think is very logical is to look at which part of the market has less froth or no froth. And we think these are the largest 10 stocks or the largest cap companies where the froth is much lesser. If you look at this ratio, look at the blue line, which is the rolling 2 year relative performance of largest 10 companies versus rest of the market. It's currently close to an all-time low, which means that when the rest of the market re-rated higher, these stocks were at the same level or lower, a notch lower level, right? This means that if you have a new equity rupee to put in the market, going towards as large as possible makes more sense. This does not mean that they will deliver absolute performance. This does mean that they are a good relative place to hide, as of today. So that could be one way to think about how markets are shaping up. Let me move to the second section and emphasize a point very, very quickly. The point is that if you buy stocks when they're expensive, there are long periods where stocks don't do anything. So there are long periods where stocks do a lot, where they give a lot of returns. For example, 79 to 92, Sensex had a 33% CAGR, and it beat very good performing gold and debt by a very wide margin. But then for 10 years, Sensex did nothing, delivered negative returns at a time when gold delivered and bonds delivered very high returns, 12% CAGR. Similarly, there are other cycles where stocks delivered like 49% CAGR, beat gold and debt by a very wide margin. And then again, they went into a hibernation for about 4.5 years. And similarly, these cycles repeat. If you look at this pictorial format, what it says is that if you buy stocks when they're expensive, you will find it very tough to beat them, even if you are exposed only to debt. So you will not be beating your debt investments if you buy stocks when they're expensive. Expensive stocks are like debt instruments with the volatility of stocks. So you have to be very careful in picking your portfolios, uh, correctly, what kind of companies you want to invest in. Our approach is that if you do a multi-asset approach where you expose your portfolio to equity, debt, international equity, gold, or four of them, usually your returns are much more smoother, mistakes are lesser, and they turn out to be more robust portfolio. These are called multi-asset allocation portfolios, and data shows that not only in India, multi-asset allocation strategies have beaten equities across the world, right? And there are many reasons. We have done a lot of research around it. um, all of you can go and read about it online. It's a very good strategy to learn about, right? The next section I wanted to, talk about something which is right now bothering a lot of people, which is the US tariffs. So currently, US tariffs are at a 100-year high. Weighted average tariffs effectively are 18.4%. Last time we saw these high tariffs were back in the 1930s, which some people also think is the reason for the Great Depression. So AI tariffs are not very healthy at this point in time. Maybe the stock markets doesn't show it. Maybe the markets think that it's a tactic for negotiation, which could be true, that most of these tariffs are rolled back. And if that happens, then the impact will be much lower. But as the things stand today, tariffs are quite high, and they can be a detriment. How can they be a detriment? The global liquidity cycle is closely linked to the US dollar. So US dollar flows to the global economy in two ways. One is when US imports a lot of things. When it imports, it buys using the US dollar. That US dollar goes to the exporting country. For example, if let's say China wants to sell iPhones to United States, it will make iPhones, sell it to United States and get dollars, right? Same way for let's say Saudi Arabia selling oil, India selling, let's say, textile products or IT services, or now even iPhones, right? So this is the channel through which US dollar goes to the world economy. This is the trade channel. The other is capital flows, where capital flows out of US into other parts of the world for investment purposes. Both these channels are under threat today. How? US is trying to curtail its trade deficit. As you can see that the dollar has already corrected a bit. A lower dollar actually helps reduce US trade deficit. In fact, the first number for June 2025 shows that US trade deficit has shrunk to about 60 billion. And with these tariff walls, with this negotiation, with a lower dollar, eventually the US will fix its trade deficit, and that will be a negative impact on other emerging markets because they rely on this channel more effectively. And this is where we talk about where the US dollar channel is very, very important. Second role is from capital flows. In terms of capital flows, the reverse is happening, where US is undermining its own position, where the world no longer wants the dollar, right? People want an alternative. Currently, there is no alternative. There is very hardly any other currency which can be as big and as strong as the dollar. So they are, you know, herding towards another alternative, which is gold, although which is very small and will not be able to replace the dollar. But marginally or incrementally, a lot of flows are flowing to that segment. So when you put the tariff war together, these two aspects, the trade flows and the capital flows, become very, very important. In both these aspects, it will create sort of a, let's say, argument against the dollar. not in terms of sentiment, but in terms of availability. When that happens, the demand for global goods and services reduces, right? So if US consumes less from the overseas entities, for example, consumes less from China, consumes less from India, Brazil, UK, other countries, there needs to be another country which has to step up and consume that surplus, right? At this point in time, only two economic blocks can do it, either Eurozone or China. These two economic blocks are big enough to sort of eat away that demand. None of them at this point in time have has the capacity to do it. Eurozone is indebted, except Germany. It does not have the economic might to step up. China is trying to deleverage. Its corporate balance sheet is already 220% debt to GDP, a very high number. Overall debt to GDP in local Chinese yuan term is 330%. So it essentially cannot lever up. It is trying to lever down, reduce debt from its real estate sector, from its banking sector, from its NBFC sector. So effectively, China is not ready. Eurozone does not have the capacity. So if US continues to pull back on these lines of trade war negotiations, trying to reduce, let's say, the dollar position against other currencies, it will eventually cause a slowdown, and gradually it will start appearing in numbers, right? And some of these numbers have already started to flow, where you are able to see these numbers. The other secondary impact of the tariffs, which is unknown, is the impact on inflation, right? Because you directly add to cost, will inflation go up? There is a case to be made where short-term numbers could go up for inflation, but it is very, very hard to pinpoint by what magnitude. And all those numbers will be only 1 year numbers, which means that if tariffs are imposed, that year's inflation number will be higher. Next year, the base will change and inflation will go back to the previous trajectory, or in fact, it could actually fall. And the reason could be that demand will be muted, right? So inflation may not be the best indicator to look at when it comes to tariff, but tariffs are not a great outcome for the global economy. Whenever there has been protectionism globally, it has backfired, right, for global economy, because currently the global economy is built through global linkages. You could argue that you can create a more robust economy by more localization. It's possible, but it will come at the cost of readjustment, and that readjustment will be costly. So maybe just to put it in so many words, I think tariff situation needs more monitoring. It also needs more monitoring in the terms whether many of the tariffs which have been imposed are rolled back or not. And please remember that rolling back of tariffs to 15% is not a good outcome. It might look like that some countries have won the war by going from 50% tariff or 100% tariff to 15% tariff. But please remember that prior to 2nd of April, tariffs were less than 2.5%. So therefore, any outcome which is 15% or higher will still be close to a 100-year high and has the potential to slow down the global economy. So these are some of the important insights that we have gathered, and I think with this I will stop here, covering some of these topics. If there are any questions, I'm happy to take them. Vikas ji, back to you. Thank you.
Thank you. Thank you so much, Sahil, for your wisdom and for all the insights that you have shared. I think I had many questions, but you have covered many of the questions that I had in my mind in your presentations. But I'll just take it from the point where you have left, which is tariff. I think this is the most important boardroom, discussion at the point. So you very well said that, we must keep in mind that it was 2.5%. And from there to 15%, 30%, 50%, whatever it is, for different countries altogether.
Yeah,
How, I mean, I want to break this question in two parts. First, how this whole tariff thing is actually going to help America.
yeah,
Second, India specifically, if you see, our GDP is not very much linked to the export other than, pharmaceutical and technology. And I think fortunately, those are two parts which have not been touched in this tariff.
correct.
So how we are actually going to get affected? Take an example, if it settles at 15% or 20% after negotiation. So if you could cover quickly both the points from American perspective and then in India.
Sure. So I think for United States, the playbook is the original playbook was that US wants manufacturing, right? The argument was that by imposing tariffs, it will bring back manufacturing and jobs. That was the reason for imposing tariffs. Now, with all the noise, those things have gone in the background. So, for example, when the US president says that I will impose, let's say, 100% tariff on a country, the original argument was that that sector's manufacturing will come back to United States and create jobs. Now, when he negotiates and goes back to 10% tariff, that argument is gone. That it will create jobs or it will create employment, right? So it is largely a political gimmick. The playbook seems to be that it wants to reduce its trade deficit, but it has taken the more tougher route of tariff negotiations. Second thing is that will it do any good to United States? I think it will probably reduce the indebtedness that the US has today. The better outcome would have been for US to reduce both fiscal and trade deficit, but as of now, it is only focused on the trade deficit. So I think eventually it will be a good outcome for United States. Will it be a good outcome for global economy or the stock market globally? That is unknown, right? Because I think market can have a knee-jerk reaction. Because if US doesn't take this step today, eventually the market will take this step, where it will devalue the dollar, force the United States to reduce fiscal and trade deficit. If they don't do it today, it will happen. Maybe in next 10 years, 20 years, 30 years, I don't know when. But if they are taking it today, that readjustment will get accelerated. So essentially, I don't think it's a very positive development for the rest of the world. For United States, it could be. As I said, it front loads what could have happened later. Second question was that India is not exposed to exports, etc. Right? So now I think we it's a right way to think about it. The only problem is that this is not how we were building our economy, right? Just about 1 year ago, we were talking about becoming a manufacturing and exporting hub, right? So suddenly we cannot take a U-turn because it remains a very viable option, right? If you want to use, let's say, exports as a route to create employment in India, it has been a good option and it can create a lot of employment in the country. So that probably will, this sector will get hampered if we don't see this progress happening. Second, the important point is that how much of hit we will get. So we can look at some numbers. India exports about $430 billion of goods and services. If you remove, if you add IT, let's say we'll go to about 650, $700 billion. Out of that $700 billion, if you remove IT, pharma, energy, uh, our total export basket, which is exposed, will be around 250 to 300 billion, right? As a percent of GDP, that number will be about 10%. But this is the exports to the whole world. Now, if you see only the United States, that number will be much smaller. So if you calculate mathematically based on, let's say, an econometric model, the GDP impact will be less than 0.5%, right? So it's not a very large impact. But the problem with this calculation is assuming that the trade war is unilateral, which means that it will be fought only between United States and India. That is not true. And I think that is a mistake all of us make when we think that trade is unilateral. Imagine that if tariff negotiations are over and United States ends up with average tariff of 15 to 18%, then most other countries will also levy similar tariff on each other, right? That is a problem. And that will cause a bigger problem for most countries, including India. So those things are not clear today. Only time will tell how that clarity emerges, and therefore we cannot think in terms of only our merchandise exports. And second, also one more prism to think about is India's strong or possibly the biggest positive for India has been IT exports, software exports. India runs a huge surplus in that area. If United States wanted to negotiate and twist India's position, it can certainly on any day say that I'm going to impose restriction on software export. that will cause India to maybe think about more solutions, think about other ways to negotiate. So these outcomes are not out of picture, right? So therefore, I think all these range of options are open because currently United States is taking a lot of arbitrary decisions, and many arbitrary decisions can be hurtful for rest of the world, including India.
Right, right, got it. And I think we've already spoken on it. One more point which I wanted you to just touch a base upon. You have already spoken about the valuation that we are at a very rich valuation at the moment. And I
Yeah,
think for last two specific quarters, I think earning growth has been very muted.
yeah,
We
correct.
are I think right now going through an earnings season, and it has not been something great. So as an investor, what should be my strategy at the moment? See, I'll tell you from two perspectives to answer it. One is from the incremental capital that I'm holding with me at the moment, and second, see, I've been an investor for last 5 7 years, and market has been exceptionally kind to me. It has delivered exceptional returns to us. So with
Correct.
this kind of a scenario, when there is so much noise, so much confusion across the globe, economies globally are slowing down. We are not so seeing growth in our own country at the moment. So, what should be the approach of an investor at the moment?
See, I would think that if you are a investor who is essentially diversified across assets, you will do fine, right? If you are, let's say, a multi-asset kind of an investor where you have exposure to equity, debt, gold, other asset classes, I think you will do well. But there are many investors, because of the recent experience of last 3 to 5 years, many of them are between 80 to 100% in equity.
Yes.
That is a problem. I think you will probably be better off investing your incremental capital outside of equities. Choosing some bond funds, choosing from debt category in totality, taking a bit of exposure to some commodities like gold and silver, getting into some REITs, where some fixed income exposure is created, also trying to build some international equity exposure. So this kind of a multi-asset approach will give you a better flexibility. It will act like a speed breaker or a seat belt in terms of absorbing some shocks. So that should be the better approach right now. Second is that if there are also investors who are very, very disciplined. For example, they will run a 60-40 portfolio, 60 equity and 40 debt. And those investors, I think, should just continue to follow that strategy forever. There is no need to rethink about those strategies because they are already very, very defensive or well diversified. My approach will be if I had a 50-50 portfolio today already, I think it will be the best approach for a conservative investor like me, maybe even lower equity is more logical at this point in time because it will give you a chance to increase your equity exposure when valuations become more attractive.
Okay, got it. So as you said, it is better to be a conservative investor in current scenarios than anything else.
I would assume that it is better to be conservative investor all the time because investment is done only conservatively. You can only think about protecting the downside. Upside you will get automatically. You don't have to work for the upside, right? But you have to work for avoiding the downside. अपसाइड तो मार्केट अपने आप कर ही देगा.
Correct. And how are you seeing? I mean, what are the catalysts which can help us in bringing back the earnings, which is
So
not there
as I
for.
said, I think we need to get back our top line growth, or the economy has to possibly see a revival. That revival can come from many aspects. So maybe higher government expenditure, um, better or stronger monetary policy response. We are already seeing some response which has happened from the RBI. Maybe more could be helpful for the economy. Third, I think the corporate India also starts to invest back, but it's like it's a circle. Which one starts first is unknown. You can't predict that. But that cycle has to get going. What will be the precursor to that cycle is unknown right now. But I think either of these, starting first and helping the other get back into shape, will be essential for the recovery.
Right. And last, before I end, Sahil, I want you to just highlight or uh, you know just give your thoughts on Reserve Bank of India, what is happening. I think the new governor is already in place. And, contrary to everyone's belief, I mean, he has handled Reserve Bank of India monetary policy very, very, differently, I would say. Putting up a liquidity of as much as 5 lakh crore into the market, I think, which possibly we had seen during COVID times.
Yeah.
And then his stand on the interest rate side, CRR, and everything that he's doing. How are you looking at the action of Reserve Bank of India from here on?
See, my guess is when you look at the Reserve Bank policy making or actions, you have to also look at the environment in which those actions are happening. So if you go back in history and go back to, let's say, the week when Lehman Brothers went bust, that was the same week when a new RBI governor was appointed. He had to do so much firefighting in his tenure that it was nearly impossible for anybody to think straight. So many things were happening on a daily basis, right? And then we had another RBI governor term where nothing happened, right? In fact, in a 3 to 5 year period, nothing happened. Oil fell, inflation fell, economic growth was normalized, policy making was normal. So I think it's in the context of what's happening externally, where you will have to think about how RBI is making policy, because I think even for policy makers, the future is unknown, right? So they don't know what will happen in the future. Currently, I think whatever RBI has done is to unwind whatever tightness was there in terms of the monetary policy until last year. It has unwound all those things so that we go back to a more normalized monetary policy or a looser monetary policy. Are more actions needed? Possibly, yes, but they have to be put into the context of what is happening globally. So, for example, if you get more trouble from external environment, RBI will have to see a question mark on the rupee, right? It will have to think about the currency, right? So I think it is trying to play a wait and watch game where it sees the external environment first and then act. And I think it's sort of taking a conservative approach now after being slightly more aggressive initially. So I think that is how I see it. I am not able to, I won't be able to make a comment whether it's a good way to deal with it or a bad way to deal with it, because I think they are much more talented, much more suited for the job
Absolutely.
rather than I can make that comment.
Right. And if I could ask you, Sahil, just to put a percentage number, I mean, whatever that is in your mind from 1 year perspective, the level at which we are at indexes, what kind of a downside we should keep in mind and what kind of upside we should keep in mind?
I think that is the only question where I have no clue. I don't know where the market will be. You can put some numbers in perspective to think about it. Maybe I can answer it this way that there is a 70% probability that the market will fall, let's say 10%, which is a very high probability, right? But there is a 30% chance um, that it will rise 10%, right? So, so you can take a bet whether it is bullish or bearish. I don't know, but I think valuations are slightly higher, so it makes sense to be slightly more cautious in approach, and it will give us ammunition when they are cheap. We'll be able to at least deploy more capital.
I got it. On this note, thank you so much, Sahil, for spending this evening with us, enlightening us. I think it was really a helpful and a guideful session, I must say. It's surely going to make difference to the investor. Thank you so much. Thank you for being with us.
Thank you very much.